There is currently a stock in my personal portfolio that I'm planning on selling. Now, a lot of the times when people plan on selling, it's because their investment hasn't performed the way they wanted, or some news has come along that has changed their investment thesis. But that's not the case in my scenario. In fact, the position I'm planning on selling is a position that I'm up nearly 50% on and also have a yield on cost of close to 5% on. So why would I plan on selling a stock that I've seen such large gains on and is also paying me very large dividends? Well, let's take a step back for a moment. If we look at my growth chart here, we can see Broadcom, stock ticker AVGO. This is a stock I'm up 163.33% on. I could have sold when I was up around 50% on this position and locked in quite a few gains, but it turns out I would have missed out on massive gains from this position. So again, why would I plan on selling out of the stock that I'm currently selling? Now, there's a lot of different investing theory on when to sell a stock, but I believe it's best articulated from the great investor Peter Lynch. So let's go ahead and turn to a quick clip of him talking about this subject, and then I'm going to reveal what stock I'm selling and why I'm selling it.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, it's funny on a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples and quadruples, because you make a lot of mistakes, and so it's ones that go up tenfold. I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. That's what I do with the company. And that's your decision. That's how you sell it.
Peter Lynch dropped a lot of wisdom on us in that video, but one of my favorite quotes that he had was in the form of a metaphor. He said, what inning of the baseball game are you in? For example, let's take AVGO Broadcom once again. If we jump over to my profitability spreadsheet and plug in AVGO and hit enter, again, we can see all this data is going to load in with the help of the Ticker Data add-on in Google Sheets, and like always, you can download any of my sheets at tickerdata.com in the link in the description. But look at the earnings per share growth of this company. Look at the 10-year revenue CAGR, 30.4%. Look at the 10-year net income CAGR, 38.25%. This is a rapidly growing company. If we jump over to the screener tab, just look at the free cash flow per share growth over the past decade, going from $1.97 per share to 2023, $42.49. Look at the revenue per share growth. It has been explosive, and like we just saw, earnings per share is rapidly growing as well. So it's clear this company is not in the 9th inning. They are rapidly growing their earnings, rapidly growing their free cash flow per share, and also growing their dividend payments over time, which will help me achieve my long-term goal of one day living off dividend income. So despite the fact I'm up over 163% on this position, I have no interest in selling my shares. Even if I saw a slight decline in the coming months or even years, I still wouldn't sell this position. Now, in contrast, let's take a look at the stock I'm planning on selling. And the stock I'm planning on selling out of in my portfolio is IBM. I'm currently up 47.24% on this position, and when I originally bought in, it had a very nice starting dividend yield, and like I said, my yield on cost is now close to 5%. If we jump back over to my stock screener tab, let's come up here and plug in IBM and hit enter. And again, all this data will automatically load in thanks to Ticker Data. Now, immediately we can see some things we're probably not a big fan of. So first off, we can see from 2013 to 2023, we've basically been seeing declining earnings per share. Now, look at the revenue per share. Revenue per share has been declining as well. Definitely not something we want to see. And then we have free cash flow per share. And it's important to remember dividends are paid out of free cash flow. And free cash flow per share has not really been growing over the past decade, so it's been difficult for this company to continue to increase dividends at a rate above inflation. Again, not necessarily something we want to see. If we jump over to the profitability and income statement tab, what we can see here again, declining revenues and declining net income over the past decade. We come over here, look at this charted out. We can see the blue bar chart is showing our revenue and the red bar chart our cost of revenue. So again, revenues are declining during this period. Now there is a quick bright spot for this company. We can see their 10-year average gross profit ratio sitting at about 49.86%, and now their gross profit ratio in 2023 was sitting at 55.45%. So they have become slightly more profitable in a sense that their gross profit ratio has increased, but just how much can that help when the company is rapidly decreasing their revenue year over year? And so again, we have to keep in mind the end goal for my personal portfolio is to one day be able to live off dividend income. So I need to find companies that are growing their free cash flow per share year over year so that in turn they can grow their dividend payments year over year at a rate high above inflation. So if we jump over to my dividend breakdown chart, let's go ahead and come up here, plug in IBM and hit enter. We can see as of right now, IBM has a very nice starting dividend yield sitting at about 3.52%. And if we look at the yearly dividend history, they've done a pretty good job of increasing those dividend payments every single year. But that dividend growth has really been slowing over the last few years. We can see the 10-year dividend CAGR sitting at 4.56%. That's pretty decent overall, especially for a more mature company, but look how much it's slowed down over the past 5 years. 5-year dividend CAGR sitting at 0.64%. That is far below the rate of inflation, meaning that technically they are paying out less in dividends every single year. And now, like we've already seen, the reason they're having to slow down these dividend payments so much is because their free cash flow is not growing really whatsoever, and the end result of growing your dividend payments without growing free cash flow is you can see the free cash flow payout ratio over time starting to increase more and more. We can see in 2013, this company had a very healthy free cash flow payout ratio sitting at about 30%, but in 2022, it jumped up as high as 69% and 2023 around 50%. So we don't like seeing the free cash flow payout ratio increase over time, and their payout ratio trailing 12 months as a result of earnings sitting at 80.51%. This company simply could not sustain increasing their dividends at a rate above inflation. So again, when we consider the fact that I want to live off dividends, that's the end goal with my portfolio. Yes, the company has a nice starting dividend yield and a good history of increasing dividends, but the dividend growth is slowing and their top and bottom lines simply aren't growing at a healthy rate. Now, the other thing that Peter Lynch mentioned is we have to ask ourselves, why did we buy this company in the first place? Well, when I originally bought this company, I liked what I saw from a dividend perspective for the most part. I knew the company had slowing dividend payments, but I felt they were trading at a great valuation at the time. And like we've already seen, this is a position I'm currently up around 47% on. So I've definitely been a beneficiary of this company riding up the market. But now we can see those dividend payments are slowing down considerably, and the company is trading at a much higher valuation. Now, to be fair, there is one potential growth driver for this company, and that is their AI-driven solutions. And IBM is considering implementing their AI in healthcare, customer service, and financial services. But we do have to take into consideration AI is becoming a highly competitive market. They're going to have to compete with some of the biggest companies in the world like Meta and Microsoft. And to be quite frank, I don't know if that's something that IBM will be able to handle. So I don't regret buying IBM in the first place. Obviously, I'm up pretty big on this position at almost 50%. But when I take into consideration what the goal of my portfolio is, and that's living off dividends long term, and I look at the future growth drivers of this company, and I consider what inning of the game that they're in, just like Peter Lynch mentioned, I realize that it is time to move on from this company, especially when I take into consideration things like opportunity cost. So go ahead and let me know what you think of this move in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import financial data straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.